Hello and welcome to Pro Trader Strategies market commentary for February the 20th. It's a Thursday. It's actually my webinar day. My name's Eric Wilkinson. Some of you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. Well, in these market commentaries, I do that same thing where I talk about the economic data, the geopolitical environment, how that impacts the overall market, but then I layer something on top of that, and that is option strategies that we can implement into our portfolios in order to take advantage of the assumptions we come up with. All right. So that's the main crux of all of this. We're trying to educate you guys out there on how you can implement options into your portfolio in regards to your assumption you come up with, whether it's oil or Morgan Stanley for that matter. And Morgan Stanley's top of mind today because big news out today that Morgan Stanley is buying E-Trade. That is in this whole, excuse me, banks trying to go out there and buy these brokerage firms in order to gather more assets under management. And all of that has to do with this lowering of brokerage or free equity trades, based on what Robinhood became hugely popular, especially with the millennials, on this free brokerage type of business. And I want to mention this because, you know, when we're trading on these different platforms, I obviously prefer TD Ameritrade. Well, when we're looking at those different brokerage platforms, you know, they charged a commission, right? And they give us the markets that are readily available out there. So it is a tight bid ask for the most part. Well, how does Robinhood make their money? Well, it's off of a spread. They sell your order flow to different institutions that create markets for you. Well, how do they create those markets? Well, it's based on what we're seeing, say, at the New York Stock Exchange or the NASDAQ, but what they do is they make that maybe a nickel wider than what you would normally see on an exchange. And when you're buying that a nickel higher and they're just scalping you on that, say for instance, if it was $1 on this New York Stock Exchange, well, you would be buying it on that platform for $1.05. Well, when you're doing it at a 100-lot click, that's a $5 scalp off of your overall yield. So keep that in mind. Generally speaking, when it looks too good to be true, sometimes it is. All right, well, without that, let me get off my soapbox and talk about, I just want you guys to be fully aware, and I don't think that they are absolutely transparent in how they do that. So anyway, all right, so let's get on with the economic data. Across the pond, we don't have a whole lot of economic data, but we did get Great Britain retail sales coming in at 0.9% higher than the expected 0.7%, and they revised last month's number slightly up by 0.1%. So a welcoming sign to see that's not in negative territory, which we have been seeing basically since, what was it? I think it was before Christmas for sure. It was like October or something like that. So we have been seeing that negative number coming out consistently. Nice to see that get back above there, showing some demand there. All right, and then they do have a European monetary policy meeting, and that basically came in line with what we were expecting. But one thing we got here in the United States that knocked it out of the park was Philly Fed Manufacturing Index, coming in at 36.7, expected to be 10.1. So a huge move in that number there, and it is the highest number we've seen since basically the middle of 2017, somewhere in and around there. So a big beat on that street number or the expected number, and just a really pretty phenomenal number in general. We also got our natural gas storages. It's on a Thursday because we had the holiday. They bumped it back a day, and it came in at a drawdown of 151 billion cubic feet. It was expected to be a drawdown of 143 billion cubic feet, showing demand there, more of a drawdown. And then crude oil inventories, we got a build of 0.4 million barrels, so less than 500,000 barrels there. It was expected to be a build of 3.3 million barrels. So a lot of things going on here. We've got this Philly Fed manufacturing sector taking in a lot of the distillates coming from the crude oil, right? So showing demand, that there is going to be demand there anyway. And then we see this drawdown happening in crude oil inventories. I don't think it's one of these we're just drawing down based on shifting it into different buckets here, especially when we see that Philly Fed manufacturing number. It shows that there is some demand out there. So we've got crude oil moving higher today by about 80 cents. It was up well over $1 just before the crude oil inventory number. That gave it a little bit of boost. I think we're seeing a little bit of profit taking going on right now. Now that we're back into the value area, it is starting to be right in and around where I've been talking about it. Probably should kind of hang out there. So gold futures moving higher today by about $11. Again, this is basically a flight to safety. You know, I put on that gold trade yesterday, maybe a little bit early, and keeping a close eye on that right now. This does look like it's getting a little bit toppy, but we are continuing to make new all-time high, or not all-time highs, but new at least 52-week high or several year highs here. You know, goes back to basically 2008 where we really saw higher into the 1700s there. Then we've got bonds here moving higher again today by about a point. Yesterday we got the FOMC minutes. Remember, we were talking about that in the daily market commentary. They were talking pretty dovish in that, which means, you know, lower interest rates are where they are leaning, and that's giving us a little bit of a boost, as well as we're seeing some of the equities come off, as you can see here, a little bit of a signal with the VIX moving higher. Dow Jones Industrial Average off by about 138 points right now as we speak, near the lows of the day. It looked like we were trying to make a recovery, especially when we saw that Philly Fed number, but it seems like there is a lot of bearishness in here. We've talked about this. We've seen some signals happening with the gold market. We saw the utilities start to spike. Remember, we talked about that. That is more of putting our money into safer type of trades rather than in the tech sector or something like that that is more volatile, which we're seeing here in the NASDAQ. Yesterday, NASDAQ was the leader of the upside move. Now today, probably one of the leaders to the downside. We've got the E-mini S&Ps off by about 14 points. One thing to note, we did see that print higher yesterday in the day session. Remember, I talked about it looked like they were going to try and print that overnight high, but we got that high again overnight as well, 33.97.5. So something we are going to have to discount. You know, if we take up that last chart again and take out the overnight session, we are going to see that take off the extended hours, that this pattern here, we did get that overnight or that day session high printed, but today pretty bearish, coming off to the lows and to that 9-day simple moving average. So that is going to show a short-term bullishness or bearishness. If we can stay above that 9-day moving average there, that is going to show that we are still bullish in the short term anyway. Breakdown below that's going to show some bearishness coming into the market on the short term. Here we have the market selling off, as you can see, as we're just in this candle. We were trying to make a drive higher based on the Philly Fed, but market's starting to show some weakness here as the day goes on. So after that institutional buying frenzy happened, we're starting to see some of the retailers really start to come in and do some selling. All right, I want to talk about a little bit more about this E-Trade. Here you go. This is the buyout, $13 billion in stock from Morgan Stanley to E-Trade. They made a huge spike here. As you can see, they are up 11% or $11 or 26%. So a huge move in E-Trade. Not so much for Morgan Stanley, but well off the lows that we saw. They were down quite a bit this morning off of that news, basically giving up that stock for 5 million accounts for the most part is what it kind of accounts to. A lot of people are saying Morgan Stanley paid up a little bit for E-Trade. You know, at the end of the day, you know, they're when the with TD Ameritrade gone, E-Trade is the next one up. There is Robinhood out there, obviously, with 10 million accounts, which is more than what E-Trade has. So that is probably going to be something that everybody is looking for to put in maybe a buyout situation. So, Goldman Sachs is maybe kind of keeping an eye on that as well. So that could start driving valuation higher for Robinhood. All right. I'm still looking at covering these calls in Disney. It didn't happen yesterday, but I am getting very close. Last I was checking, it was trading around 14, 15 cents, which is where I was at yesterday. I'm trying to get out for just less than that, about 8 cents. If I start getting this sell-off, I'll be able to cover those. Those are the March 160 calls that I'm in there trying to get out of. Remember, I originally sold those for 58 cents because I'm trying to lower my overall cost basis on my long, my synthetic long that I have going on in Disney. The other thing that I'm looking to get out of is my Microsoft. I don't know why that trade's not up there, but Microsoft coming off today. And if you remember, I have on a put spread. So you can see I'm obviously getting the directionality wrong here in Microsoft because the market is selling off for the past couple of days. So we can see that the market is coming off a little bit. We are back below this 9-day simple moving average, which is showing that there is likely to be some short-term bearishness involved in here. You start breaking below these other simple moving average, that's long-term bearishness. But right now we are looking at the short term because I have on this put spread and I am short this put spread. But one thing to note, I am still up money today based on yesterday's settlement because I'm getting some volatility coming out since I put that trade on. So being directionally wrong in this trade and theta decay obviously helping me, but more so is this volatility contraction is allowing me to stay in this trade a little bit longer. As volatility comes out, my premiums come off quite dramatically, as a matter of fact. So this is a perfect example of today the market going against me by about $2 right now, and I am making money on this trade as of today. My premiums are coming off a little bit because of the volatility is trumping this move in the equities. All right, so that's about it. Today we are going to be doing a webinar on protective puts. This is a great strategy to implement into a portfolio, especially when we're starting to see this kind of sector rotation. Maybe you're getting a little bit nervous about some of your gains, and if there is a black swan event or there is a massive sell-off in something like one of your underlyings that we were seeing in Viacom's getting crushed today. So, heading into an earnings, or if you are worried about the downside in one of your underlyings, this is a strategy that we can implement in and around that. That is better than putting in a stop order, and I'm going to explain why it's better than a stop order. Yeah, you got to pay a little bit of money for the puts rather than the stop is just a free entry, but this gives you a lot more protection, a lot more wiggle room in and around this type of trade. So I'm going to show you how to set that up and why it is worth a couple of pennies or a dime or a nickel to put this on in and around your underlying for the fraction of what it could cost you if you just put in a stop order. All right, so there's always all kinds of hidden things. Stop order seems great because it's free, but it's not always free. Just like Robinhood seems like it's great because it's free, it's not always free. So make sure you peel back the onion and know what you're getting into. All right, that's all I got for you guys, other than we got a new slide here that I got to throw up for you guys so that you guys can see the new disclaimer. Basically, ultimately, this is talking about past performance of any trading system or methodology is not necessarily indicative of future results. All right, take a minute to read over this, and that's all I got for you, other than if you can't take that, take it easy.